2023 seems to be a long year for the US market as they experienced the second and third largest bank failure in the history of the country a while ago.
To make it less likely this kind of bank failure would happen again.
The collapse of Silicon Valley Bank and Signature Bank has thrown every investor into a frenzy, sparking concerns that the US banking system may be on the verge of a disastrous collapse, with the mounting debt, rising interest rate, and a global pandemic that had led to the demise of many businesses. And now this, the current state of the US economy is not something to write home about. And the only question on the mind of everyone is, will the US economy survive this latest blow, or are we in for an even greater financial catastrophe than the 2008s? Let's start by looking at the cause of the Silicon Valley Bank folding up.
So it had to fold. It collapsed because it couldn't honor.
Silicon Valley Bank specialized in providing banking services to technology startups. The bank, which served as a major lender to these tech startups,
$100 billion in stock market value over the past,
declared on Wednesday that it sold $21 billion worth of securities at $1.8 billion loss and intended to raise $2.25 billion in capital. This plan will involve the sale of $1.25 billion worth of common stock, $500 million worth of convertible preferred shares, and an additional $500 million worth of common stock that was conditional upon the other common stock offering closing in a deal with General Atlantic.
Are recent developments that concern a few banks.
But not all of Silicon Valley Bank's issues can be attributed to one bad quarter. For decades, SVB, well funded by high-flying startups, did what most of its competitors do. It kept a small portion of its deposits in cash and used the rest in purchasing long-term debt such as Treasury bond with the motive of getting steady, modest returns as those investments promised such subject to low interest rate.
The immediate concern? The cash-burning startups who have millions in SVB.
Unfortunately, it turned out that the bank was short-sighted as they failed to take into account what was happening in the broader economy, which was overheated after more than a year of pandemic stimulus. This meant that SVB was left in the lurch when the Federal Reserve started raising interest rates in a bid to combat rapid inflation.
Given what happened today, how much concern is there about the banking sector overall?
Those once safe investments look less appealing as newer government bonds generate more interest. Due to the higher interest rate, private fundraising also became expensive.
Lester, at this point, the issue seems contained to this one bank, SVB,
leading to clients withdrawing their fund. This surge in withdrawals forced SVB to sell assets, including bonds that had depreciated because of the rising interest rate, resulting in losses of $1.8 billion. Due to this, the parent company SVB Financial's shares plummeted.
After it spooked customers with plans to sell its own shares to cover losses.
And trading in them was suspended on Friday after losses of 64% in pre-market trading and another 60% on Thursday. Some venture capital firms like Peter Thiel's Founders Fund advised portfolio companies to take their money out of the bank, despite the bank's CEO Greg Becker assuring clients during a conference call on Thursday that it had ample liquidity. Efforts to raise capital and sell the bank failed, forcing it to be shut down by the state's financial regulator on Friday.
When banks experience financial losses.
Other banks were also greatly affected by SVB's collapse, with regional bank First Republic Bank taking the worst beating with a 52% decrease in shares during early trading. Meanwhile, the US government is taking adequate measures to ensure the effect of this occurrence is minimal.
We must get the full accounting of what happened and why those responsible.
The FDIC established the National Bank of Santa Clara to safeguard insured depositors, ensuring that they have access to their insured funds by March 13, with shareholders and unsecured debt holders being excluded from the plan.
Analysts say for now a crisis has been averted and it's unlikely we'll see another.
Protections for depositors at SVB and Signature Bank were announced on Sunday by the US government, and depositors were assured that they would have access to their money on Monday.
This evening, so first SVB, then the much smaller Signature Bank fails.
The Federal Reserve also unveiled an emergency lending program to save banks from selling their securities in times of stress by being able to fulfill their depositors' needs. However, these measures don't prevent the concern about the contagion effects of the occurrence and the comparison of it into the Great Recession. Some analysts have even raised the possibility of a much more severe collapse than the one that occurred in 2008. We'll delve deeper into these fears and discuss their implications for the broader economy in the following section. The failure of the Silicon Valley Bank has sent an anxiety ripple across the financial world and raised concerns about the stability of the banking system.
New survey found most Kenyans are increasingly turning to their savings or.
While some analysts claim Silicon Valley Bank and Signature Bank issues are isolated occurrences, it's hard to ignore the fact that this is the second largest financial crisis in the United States since the Great Recession.
It really affected us, especially on food prices. It has also affected the cost of fuel.
This fact should be food for thought for everyone. The reality is, the United States banking system isn't as stable as we think it is. Although the large banks that contributed to the economic collapse in 2007 and 2008
that I've worked with, they've tolerated me for 2 years, and they're brave and kind,
are now subject to stricter regulations and have undergone numerous stress tests by regulators, that doesn't mean the whole banking sector is immune to collapse. SVB's collapse serves as a stark reminder of the banking system's vulnerability, especially given the size of the collapse. This is the second largest bank failure in the history of the US, and the Silicon Valley Bank had $212 billion in assets in the fourth quarter of 2022.
It's the largest bank meltdown since the Great Recession more than a decade ago.
Truth be told, this is a huge loss, and it will have significant effects on the entire financial system. The failure of Silicon Valley Bank also serves as a reminder that the stability of the banking system isn't something to be taken lightly.
Make sure that hopefully Silicon Valley Bank is able to open.
It isn't enough to just have faith that the system will remain stable, especially when dealing with large and interconnected institutions. We need strong regulation and oversight to ensure that the banking system is strong enough to withstand disasters. It's also worth noting that the collapse of Silicon Valley Bank has led to volatile stock markets, with bank stock prices experiencing sharp swings as investors look for secure places to keep their money.
Surprise collapse on Friday. Startup-focused lender SVB Financial Group.
Despite falling by 1.4% at the opening, the S&P 500 was stagnant in the morning trading on Monday. The sharpest drops were again coming from banks, as investors fear that the banking system may be breaking under the weight of a relentless rise in interest rates, intended to control inflation. The one at the most receiving ends are the regional banks, which are some steps below the level of the large banks that contributed to the collapse of the economy in 2007 and 2008.
The root cause of the failure here was a sudden and significant increase in interest rate.
Even after it had announced on Sunday that it had strengthened its finances with money from Federal Reserves and JP Morgan Chase, shares of First Republic fell 73%. The development of the banking system in the future remains bleak, and the severity of the effects of Silicon Valley Bank's collapse is also uncertain. Time will be the judge of all. The fallout of Silicon Valley Bank should be a wake-up call for us all that size doesn't matter in judging the resilience of an institution. Rather, we must examine the bank system closely to determine that. What do you make of this video? Let me know in the comments section. Thanks for watching this video. Be sure to subscribe to the channel for more.